Good day, and welcome back to the Life License Qualification Program video series presented by Business Career College. Again, my name is Jason Watt, and what we're going to talk about in this series of videos will be group insurance contracts. At this point in the course, you've already gone through individual life insurance, individual disability insurance, and individual accident and sickness insurance contracts. We're going to look at group insurance over the next few videos, and looking at group insurance together is going to incorporate some of those things that we looked at already in the various videos and in the textbook that you've seen to this point, but we're going to now incorporate some of these ideas. We're going to lump them together under one contract, as it were. So group insurance is designed with a little different purpose in mind than individual insurance. With individual insurance, what happens, we sit down with our prospective clients, a family, an individual, a business owner, whatever it happens to be. And we identify a risk in that case. Based on the risk, we put insurance in place in order to protect against the risk. Now, group insurance is still a risk management tool, but the need for group insurance typically doesn't come out of one of the three predictable risks. Group insurance is really designed so that employers can put a measure in place to improve their ability to attract and retain quality employees. It becomes a way of offering a benefit to your employees, and yes, the employees will get some risk management provisions, but risk management is usually not the ultimate purpose of group insurance contracts. Although as we go through, we'll see that there are many risk management measures built in. Now, group insurance doesn't necessarily have to come from an employer-employee relationship, although we will, in the process of this series, primarily deal with that employer-employee relationship. Instead, group insurance can come about really in any of three different relationships. So, as already mentioned, we know that an employer can acquire group insurance such that it will cover its employees. As mentioned, this is where we're going to spend the bulk of our time. It is also possible, though, that a union or association will acquire group insurance in order to cover its members. And then finally, it's actually very common for a creditor to acquire group insurance in order to cover its borrowers. So we'll spend a minute looking at each of these relationships, and you'll see that maybe you yourself have been involved in some of these in the past. So the employer-employee relationship, the traditional group insurance arrangement. Well, what happens here is an employer goes out, acquires a group insurance contract, and then the employees become what we call the plan members. They're the ones who would receive benefits if anything happens. It is usual in a small business for the employer, that is the owner of the business, to also be covered under that group insurance contract. A union or association will often acquire insurance for its members. This happens in large trade unions, like for example the International Brotherhood of Electrical Workers, where they will acquire a contract for insurance and then the members are covered under that contract. Those types of contracts look very similar to what you would see in an employer-employee relationship, where the contract typically includes some life insurance, probably some accidental death and dismemberment insurance, quite likely some disability insurance, and then almost invariably some extended health care insurance. But there are other types of union or association group insurance plans. If you've ever been a student at a post-secondary institution, you may have had the opportunity to join one of these plans. They tend to be relatively inexpensive. They tend to offer a fairly basic range of benefits. Maybe some accidental death and dismemberment insurance, maybe a little bit of life insurance, maybe a basic dental plan or a basic prescription drug plan. They tend not to offer disability insurance. They tend not to offer large amounts of life insurance. They tend to be fairly basic plans, fairly low cost, really designed for their members. And having read at this point Module 10, you'll have a good grasp now on the idea that insurance companies need to collect a premium that's sufficient to pay the benefits that they're going to have to pay when they pay out those claims. Creditor-borrower insurance is also very common. In fact, arguably, this is the most common form of insurance in Canada. Where we see creditor-borrower insurance, notably, is attached to a mortgage. Not only with mortgages, but also with credit cards and car loans. What might happen here? You go to your financial institution, your bank, or your trust company, or your credit union, or your Caisse Populaire, and you acquire a mortgage. You enter into a mortgage agreement, and as part of the mortgage agreement, the lender, the creditor, will often extend the opportunity to you to subscribe to their group insurance contract, and then if something happens to you during the course of the mortgage, you would have a life insurance benefit paid in the event of death, or in some cases, although less frequently, a critical illness or a disability benefit paid. So we see this is quite a common arrangement. These arrangements are quite common, but really, given what you're going to be doing, it's most likely that the contracts you'll be dealing with when you're dealing with group insurance are going to fall over here. And for that reason, we're really going to concentrate on this employer-employee relationship. So when an employer acquires a contract for insurance for its employees, the employer is going to be dealing with an insurer, just like an individual acquiring contracts for insurance is dealing with an insurer. The employer is what we call then the policy owner in the terms that we used with individual insurance, really the insured. So the policy owner or the employer actually enters into the contract. The contract then, we can plainly see, is a contract between the insurer and the employer. So they have this contractual relationship. The employees are not part of this contract. Again, as with individual insurance, this contract is a unilateral contract, meaning that the employer is not going to be held accountable, for example, for unpaid premiums. That would simply result in a lapse of coverage. The employees then, what happens here? Well, these folks are what we would call the plan members. Now, the employees have several advantages here. Notably, as a member of a group insurance plan, there's very limited underwriting. Generally, the way this works, the larger the group, the less underwriting we're going to have. So this limited underwriting means that if you're going to work for a very large employer with hundreds of employees, typically the only thing you're going to have to do to get covered is fill out the paperwork and start paying premiums. There is what we call the actively at work provision, which says that once you've done all the paperwork and we've facilitated the payment of premiums, the only thing you're going to have to do to get covered is show up at work. We're not going to cover somebody who is not healthy enough to actually show up at work. But that's a pretty simple bit of underwriting. The only time we do more underwriting with group insurance is when there are very specific needs. And this can happen when we have a very large amount of insurance sought, or when we have a small group acquiring insurance contracts. A group of less than, depending on the insurance company, 5 or maybe 10 employees may have to do some underwriting, although it's typically a lot less than what you'd face in an individual situation. You might also find that you have to do some underwriting when you're looking to acquire insurance beyond a certain dollar limit. Most insurers, when they're offering insurance as part of a group insurance contract, will insure somebody up to a non-evidence maximum. They'll insure somebody up to some limit beyond which they're going to need some underwriting. So they insure maybe for life insurance up to $100,000 of life insurance. They would call that their non-evidence maximum, and then without further medical evidence, that is without underwriting, you wouldn't be able to get more insurance than that. So we have fairly limited underwriting. We're also going to have a minimum level of participation. Now, going back to this idea that the insurer is in this business to make money, here's what has to happen. The insurer actually has to collect enough premiums to pay the benefits associated with the members of the group. If we allowed people to pick and choose their ability to join the plan, what you would most likely find is that the people who are not likely to use the plan would also be most likely to opt out. We would be left only covering the hardest to insure. However, because they're in a group insurance contract and there's no underwriting or limited underwriting, even though they would be hard to insure in an individual situation, now the insurer is going to be stuck with them. Clearly that's not a favorable arrangement. No insurer would do that business. No insurer would enter into an agreement where they know that everybody they're insuring is going to represent an unusual risk, a very high risk, and that we're going to have all the low-risk people opt out of the plan. So instead, what will happen is the insurer says, okay, employer, we'll happily insure your employees only if you can promise us that maybe 75% of them, which is a fairly common participation limit, only if you can promise us that 75% of them will stay in the plan. And the insurer knows that with a group of any kind of reasonable size, that once you have 75% of the plan members in the plan, or sorry, 75% of the employees in the plan, that now we have that reasonable level of participation, and it's likely that we have some high-risk folks, it's likely that we have some low-risk folks, and it's likely that we have some moderate-risk folks. That blend of different risk levels will allow the insurance company now to be able to calculate their premiums reasonably and have the plan members pay a reasonable cost for their participation in the plan, or for their membership in the plan. So this is where we'd see this 75% minimum participation. What we're also going to see here is that the employees will not pay directly to the insurance company for their benefits. They're going to pay through a payroll contribution. Now, it's not necessarily the case that employees pay for any portion of the plan. Some employers pay the whole portion of a group insurance plan. So we could have this payroll contribution where the employees just see the money come right off their paycheck in the form of a source deduction, or we could have an employer who pays for the plan. Now, an employer cannot put a group insurance plan in place and have the employees pay 100%. The plan is really put in place for the benefit of the employer. Like I said at the beginning of the video, the employer puts the plan in place to help attract and retain quality employees. So the Income Tax Act actually says that if an employer is going to use a group insurance plan in the way that it's intended to be used, the employer has to pay at least 50% of the cost of the plan. So the employer has to absorb at least 50% of the cost. This is what we call a minimum 50% employer contribution. If the employer doesn't ask the employees to pay anything, if the employer is going to pay the whole portion, then we have what's called a non-contributory plan. but in most cases you're going to see that employers are going to split this cost with their employees. In the oil and gas industry, for example, it's pretty common to see the employer pay the whole amount, but most other employers, you're going to find that the employer and employee split this cost. So we see that the plan has limited underwriting. It has this minimum level of participation. We have the employees paying straight off their paychecks, and then the employer remits a check to the insurance company. And we have this minimum 50% contribution from the employees. From the employer. Plans are also non-discriminatory. How does this work? Well, let's say I'm an employer, which I actually happen to be, and I have some employees working for me who I know are going to use the plan more than others. Maybe I have an employee who has quite a few children, or maybe I have an employee who's beyond the age of 50. Maybe I have an employee who I know has had some health concerns in the past. I know that those are people who are more likely to submit claims than, let's say, a 25-year-old single person who's in good health. So my tendency might be to say to the higher risk folks, I don't want you on the plan. Well, I can't do that. This ties back into this minimum participation and this limited underwriting. That in order for the plan to be considered a plan of group insurance, it has to be accessible by every one of my employees. Now, that's not to say that everybody has to belong to the plan. There are cases where people would deliberately opt out of a plan. If I have the opportunity to be a member of a group insurance plan and my spouse already has excellent coverage, I might not want to pay the premiums associated with being a member of the plan. I might not be excited about paying my 50% share, so I might opt out of the plan. But that's my decision as an employee. My employer still has the obligation to make the plan available to me. So the plan has to be non-discriminatory, and this really falls out of the human rights legislation that we use in this country. So we cannot select who's going to belong to the plan. Now that leads to another term that you have to be somewhat familiar with in order to understand group insurance, and that's anti-selection. Anti-selection refers to the idea that the insurer takes on a risk and then suddenly they see a large number of claims, an unexpected number of claims from the plan members. That's anti-selection. That is, the insurer hasn't had the opportunity to choose who's insured, so this idea that anybody can submit claims and that we had little or no underwriting associated with joining the plan leads us into this anti-selection problem. So insurers do put some limits in place to avoid anti-selection. When we look at orthodontic benefits a little bit later on, we'll see some anti-selection measures. It wouldn't be uncommon, for example, to see an insurer place a restriction on plan members that for the first year of the plan, there can be no orthodontic claims. This prevents us from having a situation arise where we put a plan in place and in that first year, 10 employees all take their kids to go get the braces they've been waiting to get. We can see that that would be a problem for the insurer. The insurer would have a large number of claims to suddenly deal with, and it would be a problem for the employer, because what happens with most group insurance arrangements is that if there's an unusual amount of claims experience, that is a lot of usage of the plan, then the premiums are going to increase commensurately. So we want to avoid those situations where we have a sudden unexpected surge in claims. It's going to hurt the insurer first, and then the insurer is going to pass those costs on to the employer. And then if the employees are paying a portion of the plan, we're going to pass those costs on to the employees again. So this really covers our basic introduction to group insurance. We will continue working through some other ideas around group insurance, some ideas around the coverages that are available under group insurance, the structures of those coverages, and a little bit of discussion around the premiums and premium structures for group insurance. I hope you'll see fit to join us for the next set of videos where we'll discuss group insurance in more detail. Thank you very much.